All right, welcome to the review session. Thank you for showing up. I know most of you have assignments that are due later today. That means probably you're done in advance, that's good. But today basically what I'm going to do is review the past 3 topics that we're covering in the final exam. Before we do that, I just wanted to highlight that all of the exam material in terms of the information about it is in the assessment folder. So if you go to the assessment folder and then you go to the examinations folder, what you'll find is today's review session, the solutions for the homework question, the formula sheet that will be on the final exam, last semester's final exam, and the solutions for the Excel portion of that final exam. So everything that you need is here. So basically what we're going to be doing today is really going through, again, the past 3 weeks of content. Now, I should also probably highlight that once you're done with your projects, like when your group feels like you want to submit, you go into the assessment section for the evaluation project, and there's a submission for your project, so the actual project bit, and the reflection. So again, the reflection is individual, the project is a group submission. You only submit it for one person in the group. You don't all have to submit it. But for the reflection, again, you submit it individually. And that one is, I think both are due on the 16th of April at 5 p.m. Any questions, perhaps?
What's the word limit?
There's no word limit or no word guide. I would say, generally speaking, past assignments have been around 20 to 40 pages. Some have gone up to 100 pages, but mostly with tables and figures and all these sort of stuff.
Sorry, for the reflection.
For the reflection, there is an explanation down here in terms of reflection. Basically, no more than 1,000 words.
Okay.
And there is, so if you're a bit stuck in terms of what do I include in a reflection, just check out the individual reflection guide, and it has some trigger questions that you can use. Again, for today, what we're going to be doing is kind of going through what we've done for the past 3 weeks, or I shouldn't say 3 weeks, but for the last 3 topics. Because again, the final exam only covers the last 3 weeks of the, last 3 topics. So generally speaking, the structure will be very similar to the midterm in the sense that will be computer-based. It will have an Excel, a Word file, and a formula sheet. The final exam will have more calculations in the sense that in the midterm, it didn't really have many calculations. It was just using numbers. Whereas here, you'll actually need to calculate some stuff. I would say that for calculations, it's the area where it's the easiest to get full marks. And it's also the area where it's very easy to make a mistake. So last time, there was a question about discounted cash flows, which is again available on the available in the folder in the sense that you can see what the question was and so on, and nobody got it right. So it wasn't actually a hard question, it's just people made mistakes here and there. So what I would suggest is that when you study, use that past midterm to do the calculation questions that you see that, the past former final exam from the last semester. And use those calculation questions just to practice to see how you do. Again, there are, solutions just so you see if you've done it right. And again, if I kind of go down, so again, here's a question on, question 2A is a discounted cash flow model. Basically, the main thing here where people struggled is how to structure it. So there's all the information here, but if you haven't actually practiced it to do it, it's very hard to actually do it once you see it. Because a lot of the formulas, they're not very difficult. You don't have to memorize them. It's about the ability to know which formula to use when. So just because there's a formula sheet doesn't mean you can basically ignore formulas completely. But again, that's probably the easiest way to study for the calculation bits. It will be topics 6 to 8. They're not going to be equal in terms of weight. Generally speaking, there will be 4 questions: cost of capital, discounted cash flow, residual income, and relative valuations. Those are the 4 headings for the questions on the final. Again, all the information can be found under assessment examinations. Now, if I go back to the midterm and where people did well and where people didn't do so well, generally speaking, there's so many areas where people kind of forgot to kind of pick up easy marks, primarily because you ran out of time. For the final, there won't be as much time pressure as for the midterm, so that will kind of help you. But generally speaking, if you are somebody who does struggle with time, outlining your answers before you actually start it makes it easy for me to just give you some part marks, even if you haven't actually expanded on the bullet points at the very end. And if you do use bullet points, explain them, and don't just explain them using like memorizing stuff from the slides, because it doesn't really tell me anything besides that you can memorize things from the slides. And again, when you can, use examples. And just as an overall hint, if a question asks you which method is superior or what's the best way and so forth, the best answer always is it depends. So there's no right or wrong answer. If you argue for one particular answer, yes, you could get a good mark, but to get an excellent mark, you basically say, well, it depends on this particular scenario. Maybe in this scenario, I would choose this method. In another scenario, I would use the other method, and you need to explain why. Again, generally speaking, if you want some detailed feedback on your own midterm, I'm more than happy to kind of sit down with you and go through it with you before the final. Again, I'm kind of jump right into the review session. Do we have any questions about maybe the final structure or anything related to the final? I think it's held on the 24th, Tuesday. Some people know this. Okay, 24th. Again, when we're looking at what's going to come now, it's about like 75 slides. It's pretty intense. You will zone out. There will be a break or two within the middle of it, just to kind of.
Recorded?
This is being recorded. I think I already uploaded the postgrad session to iLearn, but again, I'm not sure how good the audio is because I haven't actually listened to it myself. Again, this is basically just to cover the highlights of what we did, so I might speed through a bit in the sense that you should have kind of been exposed to this material before. So the first thing that we covered after the midterm was really the cost of capital. So the whole notion of cost of capital and why we need to use it is because we need to have some form of a discount rate in our intrinsic value calculations. And cost of capital is effectively the section where we estimate our discount rates. Now, the concept of weighted average cost of capital is how we estimate the discount rates in practice. Again, this concept you would have been exposed to in your maybe fundamentals of finance class or maybe some other classes as well, maybe even in accounting. And generally speaking, the weighted average cost of capital just looks at the cost of both debt and equity funding, and looks at the proportion of debt and equity that the company has. So the big deal for this week is really knowing how to estimate each component in terms of cost of equity and cost of debt. Those were basically the two hardest bits. So we started out by talking about, I guess, cost of debt, because that's probably a bit easier to understand. And the general rule is, first is, what is debt? Well, debt is effectively something that is an interest-bearing liability. The easiest way to think about it is a bank loan. What we're looking for when we try to decide if something is debt or not debt is really, is there a commitment to make fixed payments in the future? Are the fixed payments tax deductible? And is there some form of repercussion if you fail to make those payments? And all those three things qualify when, for example, for a bank loan or any other type of kind of credit account. Generally speaking, in the past, we had to also adjust for lease obligations because accounting rules used to be different in the sense that from this year's and onwards, there's not going to be an issue with off-balance sheet leases because you could have structured a lease to be off-balance sheet. From now on, that's no longer going to be an issue. But again, something that has a commitment to make a fixed payment in the future, generally speaking, because you make that commitment, you increase your risk because no matter how well or poorly your company does in the future, you always have to make that payment. Now, in terms of actually estimating the cost of the debt, so what is the interest rate that we're going to be using, there's a few different approaches. So we did say that some firms have publicly traded bonds. These will tend to be very large firms, and they tend to, a lot of them tend to be in the United States or other very well-developed bond markets. Australian firms don't necessarily use corporate bonds, so you can't necessarily go to the bond market. Now, for those firms that do use corporate bonds, you can usually find their credit rating. So Standard & Poor's and Moody's are credit rating agencies, and they'll give you a credit rating associated with any particular company that tends to issue corporate bonds. You then look at the default spread associated with that rating, and you add it to the risk-free rate. And even if a firm has the bonds outstanding, you could even just look at the yield to maturity of those bonds. So basically, what is the effective interest rate associated with those bonds? The only issue here is really that some of them might have been issued 5-10 years ago, and it might not be that relevant. Now, the hardest bit is really when a firm doesn't have a rating or has no bonds outstanding. And in those cases, we either have to use synthetic interest rate, synthetic rating by looking at the interest coverage ratio, or by looking through the footnotes to figure out whether they disclosed a weighted effective interest rate or something similar that kind of tells you what are they actually currently paying to banks and so forth. Now, the important thing for this particular topic is really that the cost of debt, cost of equity, everything needs to be calculated in the same currency as the cash flows in the valuation. So some of you, I think, are using, I guess, US firms, and you need to make sure that everything else is US basis and so on. Now, in terms of using the easiest approach, and the easiest approach is basically just identifying the credit rating, and you can grab these from Bloomberg. So for example, Disney has an S&P rating of A, and if we're looking at the default spread associated with that rating, it's 1%. And to figure out the cost of debt, you basically take the risk-free rate, you add the default spread, and that gives you the cost of debt. So it's quite an easy approach. The only thing that gets a bit tricky is that sometimes you might want to estimate your cost of debt in a slightly different currency than your home currency. So for example, Vale is a mining company that's operating in Brazil, but it's cross-listed on the US stock exchange. So if we wanted to estimate first the cost of debt in US dollars, we can then convert it to Brazilian currency by considering the differential inflation. So you effectively use this approach where you've already estimated the cost of debt in US dollars up here, and then you adjust for the differential inflation in Brazil and the US to figure out what is the kind of appropriate cost of debt in Brazil. So effectively, you just need to consider the differential inflation. Now, if you don't have a credit rating, you could create your own little synthetic rating, and all of you would have done this for your project, I'm guessing, or at least tried to do this. And there you're really just looking at one ratio, which is the interest coverage ratio. Basically, it's your EBIT divided by your interest expense. So how many times over can you pay your commitments using your profits? So you can either take your EBIT divided by interest expense, or you can take your operating income divided by interest expense, and that gives you a ratio. And generally speaking, the higher that is, the more, the better you are off, in the sense that you're a safer bet, in the sense that you, for example, Disney can pay their interest expenses 22 times over using their operating income. Again, those ratios we then use in conjunction with a table like this. So for example, for Disney, which has 22.57 as their interest coverage ratio, we then look through this table and try to find where it's placed. So Disney is a large company that's in a developed country, so we'd use the left-hand column, and it's above 8.5. In a sense, it's 22.5. It's quite far above 8.5, which means they have the best rating, which is AAA. If you're dealing with a company that is a small company or is in an emerging market, you would use the second column and so forth. So the idea here is that you're just trying to figure out what is an appropriate rating just by looking at the interest coverage ratio. Now, the important thing here is really that your synthetic rating will generally almost always be different from your real rating. So if you're a company that actually has a real credit rating, you'll find that they are different. So Disney's synthetic rating is AAA. Its actual rating is A. The main reason for this is because when we're looking at synthetic rating, we're only looking at one thing, which is interest coverage ratio. A real rating agency would have gone through like 10, 20, 30 different ratios, and they wouldn't just look at 1 year, they would have gone back and looked for the past couple of years. So it's a much more thorough approach. Not only that, but they'll probably also consider things like country risk to a much greater extent, which could also explain why Vale, for example, which is again a Brazilian mining company, has a synthetic rating of AA, whereas its actual rating is A-. So again, we have all these various issues when we have to consider synthetic versus actual credit ratings. Now, the hard part for this week was really around cost of equity, because cost of equity has a few different components. The way that we usually estimate it in practice is by using the CAPM model. And really what the cost of equity does is that it basically tells you the required return for the investors. It's basically how much they need to generate or in order to be compensated for the opportunity cost. So when they invest in your firm, they need to be compensated for the additional risk that they essentially are exposed to by investing in your firm. So the way that we kind of estimate this in practice is by looking at the capital asset pricing model. Again, you probably would have covered this in some other class, maybe fundamentals of finance, hopefully. Or at least you've done it here now. But the idea here is we need a few different components to calculate it, and that's the risk-free rate, the beta, and the return of the market, or essentially the market premium. If we know those three components, we can calculate this. So the first thing is really risk-free rate. What is it? Well, the risk-free rate is essentially a rate of return that you can get without actually exposing yourself to any form of risk. Generally speaking, what this means is that there's no default risk. So if I invest in this asset, I am sure I'm going to get this amount. And technically speaking, from a theoretical concept, there should be no reinvestment risk. So in the sense that if you're analyzing a 5-year cash flow, you want to use a risk-free rate that is kind of matched up with the timing of that cash flow. Because you don't want to have reinvestment risk, which is basically just means that when you need to reinvest it, the rate might change. But again, it's more of a theoretical concept. Again, what this means in practice is that technically speaking, the best thing to do that for example, a discounted cash flow analysis would be for year 1 to use a risk-free rate that is on a 1-year government bond, in year 2 on a 2-year bond, year 3 on a 3-year bond, and so on. In reality, nobody really does this. Because it's a bit too much work. So generally speaking, you might just use a 10-year government bond because it's a long-term bond. It doesn't mean that a 10-year government bond is the best way to do it. It's just that what people tend to do. And I think I've already covered this, I guess, for most of you for your group projects, but when you have abnormally low interest rates, you might want to use a normalized risk-free rate. And the idea here is really that if we're valuing a company as a going concern, as a perpetuity, basically, we want to use a long-term risk-free rate. Now again, yes?
Would it be more accurate if they did go through and use like a 1-year coupon and then like a 2-year coupon?
It would be more accurate from a theoretical basis. In practice, it wouldn't actually give you hugely different results. That's the only, because technically speaking, those things, the rates wouldn't be that drastically different. Because once you use a 10-year rate, it's already kind of long-term. But again, from a theoretical point of view, it's better to use 1-year bond for a 1-year cash flow, 2-year bond for the 2nd-year cash flow, and so on. It's just that people don't tend to want to go through all the burden, basically. But again, generally speaking, what this means is that you generally use a 10-year government bond. Why 10-year? Well, because somebody decided 10, 20 years ago that was the best way to do it. There's no real explanation except for the fact that it's a long-term bond and it's liquid. But to be fair, there's 30-year bonds these days, which might actually be a better thing to use. But again, nobody uses it because 10-year is the standard. But there's no good explanations for why. Again, when we're looking at government bonds, generally speaking, what we need to consider here is really, is there any default risk associated with this government bond? Now, if you're dealing with a developed country, there's usually no default risk. So if I look at a government bond in the US, so it might be 2.75%, so the current treasury bond, well, that's also the risk-free rate because there's no default risk. Whereas if I were to do this exercise in India, where there's a default risk, I need to adjust for that. So for example, in November 2013, the Indian government rupee bond rate was 8.82%, whereas its local currency rating from Moody's was Baa3, which meant that it did have some default risk. And if we go through the little kind of spread table, that bond was essentially associated, and that credit rating was associated with the spread of 2.25%, which means that in order to get the true underlying risk-free rate in Indian rupees, you actually need to subtract it from the observed government bond rate. So the risk-free rate is actually lower than what the government is paying because they're actually paying in excess of it to compensate for default risk. So again, that's really the main thing that we have to consider when we estimate the risk-free rate. The second thing that we do need to use, kind of estimate for our little cost of equity equation is the equity risk premium. And the equity risk premium is basically the premium that somebody expects to invest in an average risky equity investment. Because technically speaking, if somebody knows that they can get 4% by buying a government bond, that's risk-free, well, how much extra do we need to pay them in order for them to give us money to invest in our firm, basically? And that's kind of what equity risk premium is trying to help us to determine. So again, it's basically the premium that investors demand for investing in an average risk equity investment relative to the risk-free rate. Again, a few different approaches how you can do this. I know some of you would have used Duff & Phelps, which is basically a research firm that basically does a lot of the hard work for you. And what Duff & Phelps generally does is they go back about 100 years and they observe the risk-free rate and they observe the market returns, and they'll look at the difference over time and figure out kind of what is the average difference. And that kind of gives you the market premium from their perspective. You could also ask your boss, but again, usually your boss would be based on the opinion of people like Duff & Phelps or some other authority in the country, because again, when you can, you tend to use a third party's data, because if you mess up, you can always blame them, whereas if you actually estimate yourself and mess up, well, then you're actually liable. Whereas if you use something that is everybody else uses, well, nobody's going to blame you. So the idea here is there's a few different approaches. You can survey investors. So I know some of you would have used the KPMG valuation report to figure out what does KPMG's analysts use when kind of estimating market risk premium and so on. So there are a few different approaches here. Now the hardest thing for this week was really around the beta, in the sense that beta is a bad concept, in the sense it's very important for the valuation purpose, but there's no good way to do it. So what beta is trying to capture is relative risk. So that's kind of the gist of what we're actually trying to achieve here, is we're trying to understand the relative risk of our firm relative to that of the market. And the way that we tend to do it is by using a regression beta, where we regress the returns of the stock against that of the market. And then our beta coefficient is effectively the slope in that regression. And that gives us the relative riskiness of that stock. Now, the problem with it is because we know that, and I covered this kind of extensively in this week, in a sense that that beta is usually estimated with an error associated to it, which means that yes, we have an estimate, but it's kind of variable and there's variance around it because there's error associated with that estimate. And not only that, but when we actually estimate this regression, how do we do it? So what is the market? In a sense, do we use the Australian Stock Index? Do you use the World Index? Do you use a developed countries index or all countries index? Do you use weekly, daily, or monthly returns, and so on? So essentially, when you estimate beta, you first need to basically make a few different decisions. So one is estimation period. How far back do you go? Do you go back 1 year, 2 years, 5 years? Generally 2 or 5 years is the most common. The longer back you go, the more data you get. The more data you get, the lower your standard error becomes, which is a good thing, but the more data you get, because you go back further in time, the less relevant it becomes. It kind of comes at an expense. You need to decide on a return interval. So do you use daily, weekly, or monthly returns? Generally speaking, not a lot of people use daily, mainly because there are firms, and specifically small firms, which are not traded every day. What that means is that if you try to understand the relationship between that firm's returns and that of the market, and it's not being traded, you might actually have situations where the market goes up 10% and your firm has zero return because it's not traded. If this happens systematically over time, it biases the beta towards zero because it looks like you're actually not responding to the movements in the market. So generally speaking, weekly or monthly is the way to go. If you use monthly, you have to use a 5-year period because the general rule is you need 60 observations. Again, once you've decided on estimation period and an interval, you still need to decide on the index. And again, generally speaking, from a historical point of view, people tend to use a local stock market index. So if they wanted to estimate the beta for Woolworths, they would have used the ASX 200. The only problem with this is really that if you're trying to understand it from a global investor perspective, in the sense that you're an investor who's investing in a global portfolio, it makes no sense to know what the relative risk of Woolworths is to only Australian firms. Because if all of your other options are global, you really want to use a global market index. And again, there's a few different choices here. And again, once we actually decide on all these things, we get an estimate, but that is a point estimate. So if you remember, there's a standard error associated with that point estimate. So even though the regression beta might be 0.8, we need to take it in consideration with respect to the standard error. If the standard error is 0.2, we then can start to apply some statistical rules, because basically 68% of the time, the beta will be +1 or -1 standard error of the estimate. 95% of the time within 2 standard errors. So if the regression beta is 0.8, the standard error is 0.2. 95% of the time, it's gonna be between 0.4 and 1.2, which is like a huge range and not necessarily that useful, which is why regression betas kind of are horrible. But again, no better way to do it, so that's why they're still used. So generally speaking, because regression betas are horrible, we can start to think about it, okay, so what does beta actually mean? Beta is trying to capture relative risk. So let's think about what could impact relative risk. So one thing is prototype. So prototype might be, what do you actually sell? Even if you're in the same industry, you might sell slightly different products. So the beta of an organic food store will be higher than that of Aldi. The reason being that Aldi sells something that people need all the time, whereas an organic food store is something that is kind of discretionary in the sense that if people lose their jobs, they'll still need food, but they don't need organic food. So again, the more discretionary your product, the higher your risk is. The higher your operating leverage is, the higher your risk is. And operating leverage basically just looks at the proportion of your fixed costs to your total costs. And the idea is that fixed costs are something that you can't get rid of just because there's a downturn in your sales. So if your sales go down 20% and all your costs are fixed, well then your expenses stay the same as last year. Whereas if they're variable, your expenses would go down proportionally, which means it's better for you. So again, the more fixed costs you have, the more risky you are. The more financial leverage you are, the more risky you are as well. And again, the reason in here is really that financial leverage creates obligations and fixed payments. And again, because those are fixed, it just creates additional risk because again, your profits might plummet for the next few years, but those obligations still remain, which makes it just more risky. And again, because we do have huge differences in things like financial leverage, we can try to adjust the observed betas based on these. So when we calculate our comparable firm beta, what we tend to do is we try to unlever the beta by adjusting for the capital structure. So we're essentially trying to remove the effects of leverage. And the idea here is the more leverage you take on, the higher your regression beta will be. But if you just want to know what is the beta associated, or what is the relative risk associated with being in this particular industry, and you don't necessarily want to know what is the relative risk associated with being in this industry given a certain capital structure, well then you first need to unlever it to remove the effect of financial leverage, and you basically only have the two remaining issues that basically affect it. So again, because regression betas are horrible, one less horrible approach is to use the comparable firm beta, which basically just means that you're looking at similar-ish companies, looking at what is their regression beta, adjusting for the capital structure by unlevering it. So you get the unlevered beta, figure out what the average of these unlevered betas are, and then you relever it using your own capital structure. Again, if there's no differences between the leverage of any firms, to say every firm had a zero leverage, there won't be a difference between their levered or unlevered beta. As your firm becomes more leveraged, your regression beta goes up and you see a bigger difference. But the idea here is really that you're trying to find comparable firms because the idea is the more firms you have in your sample, so one firm's beta is horrible to use because there's a huge amount of errors, the more firms you start using, the lower your error becomes, in theory at least. So again, comparable firm beta is generally what you would use in real life if you can. Again, this is somewhat of a simplistic assumption because technically speaking, some firms are not as easy to find comparable firms for. So H&M, which this comparable firm beta is being estimated for, is quite easy because they are only in one industry and they only operate in a very specific domain. Whereas if you're starting to look at some of the firms you covered in class, in the sense of Time Warner, we had Fox, who operate in multiple segments, it becomes very difficult to find a perfect comparable firm for these types of businesses, in which case what you could do is you could use a bottom-up beta. And a bottom-up beta essentially is a very similar approach, except that instead of looking at comparable firms for the whole company, you're splitting up the company into divisions, and you're finding comparable firms within each of these divisions. You then try to find a beta associated with each division or each segment, and you then effectively try to estimate some kind of a weighted average beta based on some form of weighting, maybe based on how much assets you have in each segment or how much sales or profits. But that is kind of the approach of the bottom-up beta. Again, really useful when you can't find a perfect comparable firm. Instead of you essentially start looking into the segments. Now, the next topic that we covered was intrinsic valuation, which is comprised of two parts. One is discounted cash flow, and the second is residual income. So, generally speaking, when we're looking at intrinsic valuation, we're essentially trying to value the asset based on its characteristics, which basically means we're trying to understand the entirety of the business and all the returns, so inflows and outflows that result from that business. So the most commonly used intrinsic valuation model is a discounted cash flow model. Basically what we do is we value the firm based on the present value of the expected future cash flows. And when we implement it for valuation purposes, we can do it in two different ways. We can either value the firm based on the free cash flows to the firm, or value the firm based on the free cash flows to the equity holders. So one of them is trying to value the whole firm, so the enterprise value, and the other one is just trying to value the equity value. And again, the enterprise value can be distributed to all of the capital providers. The equity value is the one that is only available to the common stockholders. So when we're looking at share prices that we can see in the market that go up and down, what they represent is the value of the company's equity. Usually when we do enterprise values, it's primarily useful when you're buying an entire business rather than just a small portion. Again, FCFF and FCFE, main difference is who that capital is available to. So cash flows to the firm are available to all capital providers. FCFE is only available to common equity holders. Generally speaking, when people talk about DCFs or discounted cash flows, they generally refer to free cash flows to the firm because this is the most common method used. The big difference between them, besides the fact that one is they're looking at slightly different cash flow definitions, is that they're discounted with different discount rates. So FCFF is discounted using WACC, and FCFE is discounted using cost of equity. When we're looking at estimating the firm value, we're usually looking at free cash flows to the firm, but we can also value the free cash flow to the firm and essentially the entire firm value, and then adjust it for the out of the capital providers. For example, we can still get to the equity value by taking the free cash flows to the firm if we then subtract the debt value, because that will allow us to basically adjust for all the other capital providers. Again, there's a few different formulas. You don't need to memorize these because these will be given to you in a formula sheet, but you do need to kind of understand how to apply them. Again, main difference between FCFF and FCFE, slightly different numerator, and if we're looking at discount rates, the firm value needs to use WACC, the equity value uses the cost of equity. So that's the big difference between these two. And again, firm value and enterprise value is the same thing. So when you see firm value here, that's the same thing as enterprise value in another chapter, I guess specifically relative valuation. So there's a few different ways we can apply this. So one is we can try to value a firm as a perpetuity. So basically we're just assuming that the firm will continue on forever. So we're assuming a certain cash flow with a certain growth rate with a certain discount rate. So this is what this formula is trying to kind of tell you. So we're looking at the free cash flows to the firm in year one, and we divide it by the WACC minus the growth rate. And again, for equity value, the big difference is that we're looking at FCFE and we're discounting it by the cost of equity minus the growth rate. So just a slightly different approach, but very similar in terms of the formulas. Now, the first step in actually doing this in practice is you need to actually estimate what free cash flows to the firm are or what free cash flow to the equity holders are. So you need to first calculate what these are. To do this, we usually use the formula up here. For example, for free cash flow to the firm, we would use the above formula where we start with net income, we add net non-cash charges, we add back interest expenses after the after the tax rate. We then subtract any increases in fixed capital investments and increases in working capital. Now, basically, you will be given this in the exam, but you need to understand why does this formula do what it does. So why is it that we add back net non-cash charges? Why is it that we need to subtract increases in fixed capital investments and so on? The general idea is that we start out with net income and we then try to get to the cash basis by basically adjusting for things which are different between cash accounting and accrual accounting. So we think about net non-cash charges. The biggest item here is depreciation. Depreciation does not result in a cash inflow or outflow, whereas depreciation decreases net profits. So in order to get back to cash flows, we need to add it back, and that's why it's added back. If we instead look at, for example, investments in fixed capital, well, that's basically if you purchase a new piece of machinery for $1 million, well, it's not going to be represented in your profits because it doesn't necessarily care about huge purchases. We're going to be depreciating it from year to year, but it's not considering huge purchases. So to get to cash flows, we actually need to subtract any purchases of new machinery. Similarly, if your working capital goes up, and generally probably the best example here is if your accounts payable go up, it generally means that you have some sales that were credit sales. So you didn't actually receive all those profits in cash because some of the sales would have been credit sales, which you actually haven't received in cash yet. So if you have an increase in working capital investments, which generally just means people owe you money, well, then you did not receive all the cash yet, which is why we subtracted. Again, when we're looking at net non-cash charges, it can include many different things, but basically it's trying to adjust for things that are not, or basically there are representing the differences between cash accounting and accrual accounting. So for example, if we have a deferred tax liability, well, we then add it back because we haven't actually paid those taxes in cash, even though our tax expense on the accounting statement says that we have. And that's kind of the rationale behind most of these. Again, how do you calculate these things? Well, in a question, you might be given a bunch of assumptions around EBITDA, depreciation expense, interest expense, and so forth. And you might be asked to use these information to calculate free cash flows to the firm and free cash flows to the equity holders. This example is slightly more difficult in the sense that you're not given net income. You need to calculate it first. Well, to calculate net income, you can start with your earnings before interest, tax, depreciation, and amortization, which is the top line, and then obviously adjust for interest, tax, depreciation, and amortization. So what you would do is you would take that $1,000, you subtract depreciation, you subtract the interest expense, which gives you the earnings before tax, and you multiply it by 1 minus the tax rate, which gives you the net profit. Once you have net profit, you basically just plug and play in terms of the formula we had on 2 slides back. You add back net non-cash charges, which is your depreciation. You add back your interest expenses on an after-tax basis. You subtract any increases in fixed capital investments, and you subtract any increase in working capital. So again, the important thing here is not necessarily knowing how to apply this formula, but knowing why the formula is the way that it is. So why is it that we have to subtract fixed capital investments? Why is it that we have to subtract working capital investments, and so on? The main difference between the FCFF and FCFE is one, FCFE does not add back interest expenses. The reason being is that this cash flow is only available to the common equity holders. The cash flow available to the common equity holders is after we've already paid the people we owe money to. The second big difference is really around the net borrowing. So if we borrow money from a bank, it actually represents a cash inflow from the equity holder perspective. So that is why when we borrow money from a bank, we actually add it to our free cash flows to the equity holders. Again, once we have this information, we can then start to kind of try and apply it. The way that we apply it, we could use, for example, a multi-stage model. And a multi-stage model basically just says that in different periods of times, there might be different growth rates. And at the very end, we generally have an assumption of perpetuity. So we first have a sum of cash flows that we discount back to the present value. We then have a perpetuity, which we then, in the last part of the formula, discount back to the present value. And again, there's an example just here. So what we start off with first is a few different assumptions here. We're told that the current free cash flows is 100 million. We have 300 million outstanding shares. We have long-term debt of 400 million. And we're then given different growth rates from year 1 to 3, 4, and 5. So 30% for the first 3 years, 24% after that, 12% after that, and then from year 6 and after is 5% with a discount rate of 10%. So again, for an exam, this will be a good question to have, for example, in the sense that it kind of forces you to kind of go through the thought process here. So the first thing you need to do is essentially just structure your little table here. So in each time period, how much was my free cash flows and how much is this worth in present value? So First thing that you need to do is just figure out what is the cash flow in year one. Well, the cash flow in year one is based on the cash flow in time 0, which is 100 million, plus the growth of 30%, which gives you 130 million. In year 2, it would be 169 million because it's the 130 multiplied by 1.3. So this gives you your cash flows. You then discount them back to the present period, present value by taking the free cash flow divided by 1 plus the WACC, which is 0.1. So it's going to be 1.1 to the power of 1 in year 1, to the power of 2 in year 2, and so on. So again, I know some of you haven't done fundamentals of finance for a while, but that's kind of your discount rate formula. So once you have those individual cash flows, so year 1 to 5, you still need to value the perpetuity. So what's going to happen in year 6 and onwards? So once you're in year 5 and you kind of have estimated this, well, what's going to happen thereafter? So in order to do this, we need to use the perpetuity formula. And the perpetuity formula says FCFF n plus 1, which just means the next period. So when we're valuing the perpetuity, we're always valuing it in year $5 here. So we're valuing it from our specific cash flow streams. So we need to know first, in terms of FCFF plus 1, is year 6. So year 6 is 320.4, which is why we have 320.4 there. We then divide it by the WACC minus the growth rate, so 0.1 minus 0.05, so 10% minus 5%. That gives us, so the first portion of this equation gives us the value of the perpetuity. So this is the value of the perpetuity in year 5. That's the first portion of the formula. The second portion discounts it back to the present value. That's all it does. So the second portion basically discounts the value of the perpetuity back to the present value. Because when we estimate the perpetuity in the beginning, we do so in year $5. We need to bring it back to the present period by multiplying it by the discount factor, which you get by taking 1 divided by 1 plus the WACC to the power of the period that you're actually in. So you take it 1 plus 1, 1.1 to the power of 5, and essentially you get a discount factor. Again, this will give you a terminal value, and then you can effectively try to estimate the entire firm value. So you take all those present values that we calculated in 2 slides back. We then add the value of the perpetuity. That gives us the firm value. We can then get to the equity value by subtracting the debt value of 400, and we then divide this equity value by the numbers of shares outstanding to get an equity value per share. Everybody's getting kind of tired. Soon we'll take a break, don't worry. The only 2 things that we do want to consider when we're doing discounted cash flows is, one, when we're using discounted cash flows, we might want to use something called mid-year discounting. And mid-year discounting just acknowledges the fact that when we're looking at free cash flows, they don't magically appear at the end of year 1, at the end of year 2, at the end of year 3. They're accumulated throughout the year in the sense that you make sales, you have expenses throughout the year. So to solve for this, and to avoid discounting things a bit too far back, you use mid-year discounting, which means that when you discount this 130, you're going to take that 130 divided by 1.1 to the power of 0.5 instead of to the power of 1. So it's taking it you're basically subtracting 0.5 from the year in which you're discounting, because you're assuming that the cash flows on average would have been received in the middle of the year. Again, it's a simplistic assumption, doesn't make a huge difference, but basically it's there just to make it slightly more accurate. And then finally, the other main thing when we're looking at discounted cash flow is really around non-operating assets. Let's say you have a real estate company which has huge pieces of land that they're not using. They have all this value, but it's not necessarily going to be reflected in their cash flows. So the discounted cash flow model only considers things that would be considered in your cash flow statement. So if things are not generating cash currently, it's not going to be shown in your valuation. Because when we're looking at discounted cash flow models, it's only really valuing the operating assets. So non-operating assets like things like land, which you're not currently using, or even huge cash holdings, which are not necessarily getting a huge interest rate, would be considered your non-operating assets. So the value of the firm is really your value of your operating assets, which is what you get from the DCF, plus the value of your non-operating assets. We might take a break because I know you guys are like exhausted already, or do you want a break? Yeah. Let's do 5 minutes at least, and then we'll come back and finish early, all right? Cool. All right, so let's continue. Hopefully we'll finish early-ish. Before we finished off, we basically just talked about free cash flow analysis and this kind of cash flow models. And really, the only thing I forgot to mention was really the idea that when we're comparing FCFF versus FCFE, the reason why we're considering FCFF is because it allows us to adjust for the differences in leverage. So FCFE is a levered DCF, FCFF is an unlevered DCF. So if you want to compare firms to each other, usually the free cash flow to the firm approach is better. So similarly, when we talk about multiples, an enterprise value multiple is better to use when you do have different capital structures. Now, the second part for the intrinsic valuation was really about residual income, and residual income takes a slightly different approach in the sense that it ignores cash flows, but instead says that the value of a firm is equal to that of its book value plus the present value of the future residual income. And the residual income is merely the net income of a firm minus an equity charge. So we basically ignore the fact that a company makes profit, because what we really are concerned here with is, did it make an economic profit? And the way that we figure out the economic profit is by subtracting an equity charge, which is there to compensate common shareholders for their opportunity costs. So for example, in this example, we have a company that has a positive profit of about 96,000. Its beginning equity capital is 2 million and the cost of equity is 12%. The equity charge is that 2 million multiplied by the cost of equity. So the equity charge is 240. We have our net profit of 96, subtract that 240, and you get a negative residual income. So even though it's a profitable firm, it's actually making an economic loss. So if you want to think about it from a continuing perspective, they're basically destroying shareholder value. And if we don't think that they can actually generate a positive residual income in the future, they should probably just stop now, because their value will be just decreasing as they go on into the future. So when we're looking at residual income valuations, there's a few different ways to do it. So one is that you, in an exam situation, you might begin something like this, where you're given the earnings per share for a number of different years. You might be given some other information about dividends, about $1, $1.25, and $12.25 for the next 3 years. The fact that the last year is a liquidating dividend and that they will cease operations after year 3, what the current book value is, and the cost of equity being 10% in this case. So the big deal when we're looking at residual income is that we need to compare that earnings per share that we're given to an equity charge to figure out what the residual income is in each year. To figure out what the equity charge is in each year, in this case, what we're going to be looking at is trying to figure out what is the beginning book value in year 2 and year 3. Because we know what the beginning book value in year 1 is, it's $6 per share. But to figure out what it will be in year 2, what we need to do is we need to take the net income in year 1, which is $2, add it to the 6, which gives us 8, and then we subtract the dividends paid out, which gives us the ending book value. And that is essentially going to give you the beginning book value next year. So again, the $7 is merely 6 plus 2 minus 1 gives you 7. In year 3, it's $7 plus 250 minus 1.25. So it's essentially beginning book value plus profits minus dividends. So it's your change in your retained earnings that you're trying to figure out, because the differences in book values from year to year is basically in the, can be traced back to net income and dividends. Once you know what the beginning book value is for each period, you can then calculate the equity charge for each period as well, because it's 10%, so 60 cents in the first year, 70 cents in the second year, and 82.5 cents in the third year. You then subtract that equity charge from the net income per share which you're given. So in the year 2, for example, when net income is 2.5, the equity charge is 0.7. Your residual income in that year is $1.8. So the first part is really just figuring out what is the residual income in each particular year. Because we know the firm terminates here, we don't need to calculate a perpetuity. All we need to do is we need to discount each period into back to the present value. Again, the big difference between this and this kind of cash flow model is that we take the beginning book value as our starting point and then add the present value of our future residual income. So for example, the year 2 residual income of 1.8, $1.80 per share, we divide it by 1 plus 1.1 to the power of 2 because it's in year 2, and we bring it back to the present value and so on. So we get the present value of each of these streams, sum them all up together with the beginning book value, and we get the value per share of $11.15. Again, not that difficult if you see it, but again, I would recommend to practice it just so that you know how to do something like this.
So just on that, so from that table,
Yep.
what values would you give us? So just the
You only need this to do this.
so
Yeah.
so
Yeah. So you will not be given any form of templates.
good.
So again, the hard part is really knowing what to do given a scenario. So similarly, like you don't need to memorize formulas, but it's hard to know which formula you should use unless you've basically tried all of them when you practiced. So again, the example I gave of the cash flow question as well, technically speaking, this scenario can be answered using the approach that we had a few slides back with the multiple periods of different growth rates. But you need to know that that's the way to structure it by using this information. That's kind of the hard part, I would say. But again, if you've practiced it, it's not difficult because then you're like, different growth rates. I need to calculate each individual cash flow for the first X amount of years. And then I know that from year 5, it's growing at a certain rate. Now, you could also look at residual income as a function of a firm's return on equity, because technically speaking, a firm's residual income can be viewed from a return on equity perspective. If a firm has a greater return on equity than its cost of equity, well, it's going to have a positive residual income because it's generating more than the equity charge is. So again, when the return on equity is greater than the cost of equity, residual income is greater than 0, which means that the value of the firm is above the current book value. Whereas when your return on equity is less than the cost of equity, you're effectively destroying shareholder value because your residual income is less than 0, which means that your book value is actually higher than what the total value of the firm is. So in this scenario, if you don't expect that this will improve over time, it's best to just liquidate and basically stop operations. Now, you could value the entire firm by looking at the firm's return on equity. So in a sense that you could take a formula approach by using a return on equity rather than the earnings per share like we did in the 2 or 3 slides back. In this scenario, for example, on the next slide, we're given the information that the current book value per share is $30, the return on equity is 18%, the required return is 12%, so the cost of equity is 12%, and the growth rate is 8%. Again, if you're given the information, the hard part is knowing that you should use that formula. Once you know that, you just plug it in, and you effectively can calculate what the value per share is, which is $75. So again, the beginning book value plus your return on equity minus your cost of equity divided by your cost of equity minus the growth rate multiplied by beginning book value. Again, it's just having some practice with some of these examples and kind of working them through yourself to figure out how to do this. One thing that we do consider when we're thinking about residual income is really about persistence of residual income. So you can either assume a perpetuity, similarly to how we do it with the discounted cash flow model. In a sense, we assume that the residual income will increase over time because it has growth rate. But you can actually assume the exact opposite in the sense that residual income will decrease over time. And the way you do it is by incorporating a persistence factor. And really the idea here is that we know from our forecasting week when we talk about mean reversion that it's hard to make above average return on equity compared to others because of competitive forces. So similarly, over time, residual income will gradually decrease because of new entrants to the market. So there's a few different scenarios here in the sense that we could assume that residual income will stay continuously the same forever. It might decrease to 0 after the next year, or it might have a gradual decrease. Usually in real life, there's some form of a gradual decrease, which we tend to call persistence. So the higher the persistence, the less it decreases over time. Whereas a low persistence means that it drops in the next period quite dramatically. So a high persistent firm would generally be some firm that might be paying out a low dividend, because if they pay out a low dividend, they reinvest money. Reinvesting money ensures that you have high returns in the future with new products and so on. Whereas if we're looking at low persistence, it's generally firms that might have huge return on equities right now, but there might be because of accounting manipulation or that they have one-off items that boosts return on equity to an extreme level this year, but it's not representative over a longer time period. So you can make a few different assumptions here. And again, this formula, you don't need to memorize it. All you need to know about this formula is that really all we're concerned about is the persistence factor. So the persistence factor is the factor we include to account for how quickly the firm's residual income will decay. So if it's 1, we assume that there's no decay, so it will basically stay consistently flat. If it's 0, it drops to 0 after the, initial period, and somewhere in between, it basically gradually decreases. If we observe, a large sample of real-life firms, generally speaking, this persistence factor is around 0.6, so 0.62 in reality, which means that firms' residual income does decay over time, but again, it's because of competitive forces. So again, I don't want you guys to memorize the formula, but you need to know how to apply it. You need to understand why do we need to consider persistence. So in this example, we might actually use this persistence formula with the assumptions of a beginning book value of $20, residual income in year 2, 1, 2, and 3 of 50 cents, 85 cents, and $1, required return on equity of 10%. We're assuming a termination after 3 years, and we can also assume a persistence factor of 0.6, which is kind of given you at the top of the slide. If you assume all those things, what you do is something that's very similar to the Bug Properties example, in the sense that you begin with your book value per share. You then discount the first 2 initial residual income streams, and for the last one is where you account for the persistence factor. And you effectively include it here where you have the persistence factor sign. So you effectively include that 0.6 into that equation, and if you kind of work it through, you get a value of 22.81. Again, for me, the most important thing is that you just understand what a persistence factor is and why we need to consider it. And again, it relates back to competitive forces, because we can't assume that companies will generate above average abnormal returns for a very long time. Now that we've covered both of these approaches in the sense of DCF and residual income, which one is better? Well, again, it depends. A good answer should say, well, it depends. Because technically speaking, residual income, it has a greater weight on book value, whereas discounted cash flow has a greater value on terminal cash flow streams, in the sense of terminal value of the cash flows. You could say that the pro is that it has a large weight on the book value for the residual income model, because perhaps current book values are more reliable, whereas if you're looking at having a larger weight on later cash flows, it's slightly less reliable just because anything that we need to estimate for the future is going to be having some error in it. So if we have a large terminal value for the cash flows, it will have some error in it just because it's been forecasted for the future. So again, big strength for the residual income is really put slightly less weight on the terminal value. Uses accounting data, which is kind of a pro. It's used for firms that don't have positive cash flows or have unpredictable cash flows. So some firms' cash flows go up, down each year, which makes a discounted cash flow model quite hard to use. In these instances, a residual income would be quite nice. However, it does rely completely on accounting data, and it's very, very sensitive to all the accounting assumptions, specifically around all the issues that might impact your book value. So if I look at most of the weaknesses around residual income, it's really to do with the accounting practices and how it's kind of susceptible to accounting issues. So this slide basically goes through all the different issues that could impact the residual income model from an accounting perspective. I would recommend that, yes, I could mention a few items here now, and I will, but there is a section in the readings where it goes through each and every one in quite a lot more detail. So if you're confused, just go to the readings for this section. So again, I would want that everybody does all the readings for the exam, but I know that's not going to happen. So instead, find stuff you don't understand, go to the readings and figure those things out. But the general idea here is really that residual income, very, very sensitive to the fact that book values are correctly valued, in the sense that your book value is the true value of your book value. The idea here is that, technically speaking, there's a huge issue with intangible assets, because on one hand, if you have a huge amount of intangible assets, let's say your brand value, if it's not in the book value, On one hand, it'll undervalue the firm because the residual income model looks at your beginning book value plus the residual income stream. So if you don't have the brand value in the beginning book value, it might undervalue the firm. But on the other hand, when you calculate the residual income, you need to figure out the equity charge, which is also dependent on the correct estimation of book value. So you actually, if you've excluded brand value from there, or basically if brand value is not there, you're actually understating the equity charge over time. So they're kind of two opposing effects. But the idea here is really that residual income model is very, very sensitive to any form of issues with respect to book valuation. Again, generally speaking, I would recommend for you for the exam is to actually read the part in the chapter. So if you read something for this week, this would probably be the most useful in terms of stuff that you can't just figure out by looking at this bullet point. Cool, so the last part that we covered was relative valuation, which I wouldn't say it's a hard topic. It's really knowing that there's different multiples out there, and there's different scenarios where you would choose to use one multiple over the other, and basically knowing when to use it. That's kind of the hard part. So again, relative valuation assumes the law of one price in the sense that similar assets should sell at similar prices. Basically, we're valuing a firm compared to how other similar firms are valued, and it's usually applied by using some form of a multiple based on comparable firms. So the things that we need to consider for this week is one, how do we select comparable firms, and which multiples could we potentially use, and in what instance. So the most common multiple that is used is the price to earnings multiple. So again, the price to earnings multiple just looks at the function or the price of a firm in relation to its earnings. So if the PE multiple is 10, it means that if your earnings is 1 million, your value or your price should be 10 million. So it's basically multiple of your earnings. The idea of why people focus on it so much is because everybody's obsessed with profits, because that is really what you're generating for the shareholders. So EPS, or earnings per share, or profit, is a driver of value. It's widely used. People obsess over it. The real drawback with this is really when you have negative or very small earnings. So when you have zero, negative, very small earnings, you can't use a price to earnings multiple. When you have a lot of items that might be transitory, you're going to have issues because, again, a price to earnings multiple generally looks at 1 year's earnings. So if that year's earnings is completely out of whack because you have a bunch of one-off items there, you're going to have issues of trying to separate out the transitory components from the rest of the earnings number. And then finally, again, it is using accounting information, so there will be issues around management discretion. Now, for any of these multiples that we're talking about, you could talk about the idea of using a trailing versus a forward multiple. A trailing multiple uses last year's earnings, for example, for PE. A forward multiple uses next year's earnings for PE. The idea here is that, technically speaking, the market works on expectations, which means that the forward multiple is always best to use. The main reason why you might not use this is because you don't have access to forecasts. If you don't have access to forecasts, use a trailing multiple. The big difference between these two will happen when there's a huge difference in the earnings from one year to the other. So generally speaking, we use the forward multiple, but if we can't, we can use a trailing. Again, there's a whole bunch of whole bunch of issues when we calculate earnings per share. One is around share dilution, in a sense that the numbers of shares outstanding is not actually the true numbers of shares outstanding, because there will be some options, warrants, and other type of financial instruments, which effectively mean that there's actually more shares outstanding than the company usually discloses. There will be some issues, as I've already mentioned, around figuring out which components of your earnings are transitory versus permanent, and that's really around trying to figure out what is the true underlying earnings number. Yes, they might have reported a 2 billion profit, but what is the underlying earning that's going to consistently persist into the future? Maybe we've had a huge jump in earnings this year, so we might need to normalize it by going back for the past 5 to 10 years, take an average of the earnings, or, for example, take the average of the return on equities to figure out what is a normalized return on equity and apply it to our current book value. And again, whenever we're dealing with accounting issues, if we're dealing with companies that have different accounting methods, it's also going to screw some things up. not only when we're dealing within one particular country, but when we start to compare countries to each other and have different accounting methods, it's also going to create issues. So when we're looking at applying any of these multiples, we need to figure out what is our benchmark value. And our benchmark value is basically what are we going to compare ourselves to? What are our comparable firms? There's a few different options. The one that you've chosen for your project is to use some select industry peers. So basically select 3 to 5 companies that are very similar to yours and use them as your comparable firms. Look at how they're valued, look at their average multiples, and apply them to your own earnings, book value, and so forth. You could also look at slightly different approaches, which is one, looking at the sector as a whole, so more firms, the market index, so even more firms, but at the expense of becoming less and less relevant, in the sense that you have more firms in the sector, but a lot of those firms will be very different from yours. You could, on the other hand, also just use your own historical firm values as a benchmark, because it will kind of tell you how you're valued right now in comparison to how you were valued in the past. But again, if your firm has changed dramatically from year to year, it kind of would explain why you might be valued differently. But again, there's a few different approaches. Usually selecting your industry peers is probably the most relevant approach you can use. So again, when we're looking at any of these approaches, what we select is, again, let's say we select a few select company peers like you've done for your project. We assume kind of a law of one price in this instance, in the sense that similar firms should be valued at similar prices. But technically, companies are not one and the same. They're not identical. They're different. So even though they're in the same industry, does not mean they have the same growth rate, does not mean they have the same product portfolio. So we need to consider some of these things. One of the things that we could consider is the price to earnings to growth ratio, which basically tells us what your PE is in relation to your growth. So in this example, we have a firm with an earnings per share growth rate of 8%. The current forecasted earnings per share is $4.50, and the current stock price is $28. Whereas if you look at its peer group or its comparable firms, the median price to earnings ratio is 9, and the median price to earnings to growth ratio is 1.6. If we apply the top section and try to figure out what is the price to earnings ratio for our firm, well, divide 28 by 4.5, which gives you a price to earnings ratio of 6.2. Divide that 6.2 by 8, you get a price to earnings to growth ratio of 0.78. Generally speaking, when it's below 1, it could indicate undervaluation because you're basically not being compensated for all of your growth. And again, if we wanted to value the firm based on median PE multiple of 9, we then multiply our own value of 4.5, our own earnings per share, multiplied by the median PE ratio, and you get a value of 40.50. Again, based on this, it would seem that the company is undervalued in a sense that using a median PE multiple will give you a value of 40.5, whereas the current value is 28, so it looks like it's undervalued. Not only that, but our price to earnings to growth ratio is much lower than that of our competitors, which seems that our growth is not being valued to the same extent. So it looks like it might be undervalued, but it depends would be the correct answer, because technically speaking, it could be because our growth rate of 8% is not going to persist much longer after that. So even though that's the 5-year forecast, after that might plummet compared to our competitors. So it's not necessarily valued to the same extent. Now, if we can't use our earnings per share for one reason or the other, we could use an alternative ratio. So for example, if you have a firm that has negative or very small or zero earnings, you can't use a price to earnings ratio. If you have a firm that will terminate, you can't use a price to earnings ratio. If you have a firm that is purely based on its assets, it's much more appropriate to use a price to book value multiple. So if you, again, have a number of situations where this might happen, you should probably use a price to book value multiple. The reason is, again, technically, book value is almost always positive, which means that if we do have a situation when we have negative earnings, we can always rely on book values. They tend to be more stable, positive, and so on. And if we look at some firms, they're very much asset-based financial firms. Their value is based on their financial assets, which tend to be valued at fair value. If they're valued at fair value, well, technically the value of the firm is probably its book value. So for some firms, we can just look at its book value as a benchmark for its actual value. And again, if the firm will terminate, well, it's not appropriate to value it based on its sales or earnings because they will not persist into the future. The problem here is really that book values are very susceptible to a bunch of accounting issues. So all the things that you learned about residual income, plus a few others, in the sense that one, non-physical assets, which is a huge thing. If it doesn't include your intangible assets like brand value, you're gonna get weird numbers. It's gonna be misleading when you have different asset levels between firms. So just because you're in the same industry does not mean you have the same strategies. For example, H&M, they don't actually manufacture any of their own clothes, they just buy it from outsourced manufacturers. Zara, for example, which is technically looks like a similar firm, manufactures everything on their own. So they actually have different asset levels because one manufactures everything and need manufacturing facilities. So just because of that, it's going to be misleading to use this between different companies. Again, when you have different asset ages, what this really refers to is historical cost issues. So you buy things at historical cost 100 years ago, you buy it again and account for historical cost at 50 years ago, it's going to give you weird numbers. So the idea is that when we're using price to book value, there's going to be issues primarily to do with book value issues. So again, intangible assets, inventory accounting for the United States, like your FIFO versus your LIFO, all balance sheet items. In the past, this would have been including leases. These days, it's not that big of an issue, but again, fair value is always going to be an issue for book values because sometimes some companies or some of your competitors might hold all their assets at historical cost, whereas you hold them at fair value. Using their multiples makes no sense in that case. Now, you might actually have some situations where you can't use a book value multiple or a price to earnings multiple. So this could be, for example, when you have a situation of negative earnings and a firm that is service-based. So in the sense that they don't actually have much assets to value them on. In which case you might use a price to sales multiple. Because technically speaking, a price to sales multiple will always have a positive numerator because sales will generally always be positive. You can also use this quite easily for firms that you suspect to have accounting issues. So if you suspect a lot of accounting fraud and accounting manipulation, price to sales is better to use just because you only have one line item to, or I should say probably 2 or 3 line items to worry about because it's the very top of the income statement. Whereas profits is at the bottom, which means that you could manipulate many different items before you get to the profits. So the idea is that price to sales is just another benchmark multiple. It's probably the worst one to use, but if you have no other option, this is what you use. The reason why it's the worst one to use is because sales does not actually tell you anything about earnings or cash flows. It doesn't actually reflect a good consistency between the numerator and denominator in the sense that price, the claim of the equity holders, sales is technically the claim of all the capital providers because it's before you've actually paid them out. It doesn't reflect any things around the cost differences because some of your competitors, they might have a much better expense management ratio than you, which means that they can convert those sales into profits much better than you can. So again, there's a whole bunch of reasons why price to sales is not necessarily a great ratio. Yeah.
Because it isn't a great, or is one of the reasons it isn't a great multiple to use is because it's so simplistic?
Well, they're all simplistic, but this one is just simplistic in the sense that primarily because sales does not actually tell you anything about the returns. So it's even more simple than the others because at least the others look at book value, which is assets you own, and earnings, which is at least something you generate to the shareholders, whereas this only looks at sales, which is kind of weird. Again, I've mentioned it in the DCF or intrinsic valuation section, but when you do have companies with different leverage structures, you might need to consider things like valuing the entire firm. So similarly, when we're looking at multiples, we might look at enterprise value multiples. So we would use these multiples when your comparable firms and your firm have different leverage structures. And essentially your capital structure of one company might be 10% debt to equity, yours might be 80, somebody else's might be 70, somebody else's might be 20. When you have the situation, it's very hard to use a price multiple because price very much influenced by capital structure. So in this instance, usually the most common multiple is your enterprise value to EBITDA, which basically looks at EBITDA as a proxy of cash flow because it kind of is used because people think it's a great profit measure because it's kind of similar to cash flow. The only problem is that it kind of exaggerates cash flow a bit, which means it's not awesome, but it's still probably the most used multiple, specifically when a company acquires another company. Because when you want to value the entire firm, so it's enterprise value, this is the most used multiple in reality. Again, the reason why it's used in reality is because, again, it's very useful for comparing firms of different capital utilization, so essentially different capital structures. If you have a negative EBITDA, you're going to use a sales multiple, which is their enterprise value to sales. Again, all the horrible things with the sales multiple, the only difference between a price to sales multiple versus an enterprise value to sales multiple is really that, again, useful for comparing firms of different leverage. That's the big difference here. So again, a whole range of things for this week. It's really just understanding there's a whole bunch of multiples, some advantages, disadvantages with each one. So in which instance would I use one over the other? That's really the hard part. We did have some issues around GAAP versus IFRS. In a sense, I think we did mention that GAAP tends to produce lower net income, so net income tends to be higher under IFRS. Equity, or so book value, tends to be lower under IFRS, so, which by definition would mean that return on equities tend to be higher under IFRS. So again, these are some of the issues. We also had some issues around, do we figure out if we're going to use a raw mean in a sense of an arithmetic mean? So once we select our comparable firms, figure out what the multiples are. Do we just take a straight average, or do we weigh them based on the size of the firms? Again, there's no good answer here. Generally speaking, people tend to use a simple average just because it's very easy. That basically concludes most of it. The last slide is basically just an overview of most of the content for the exam, in the sense that if you want to get a cheat sheet to figure out what do I need to know and do I know it, go through this and make sure that you can do all those things. For example, for the market premium, know how to define it, know how to explain it, know the different approaches and so on. So for the calculations, know how to calculate the cost of capital, differential inflation when calculating the beta, know how to calculate the comparable firm beta, and so on. The idea is here is basically that you can kind of go back to this to figure out what you can and can't do. Any questions perhaps? Easy?
So we can't bring in cheats.
Huh?
No cheat sheet.
There's unfortunately no cheat sheets except your brain. That's fine. Otherwise, again, for the next 2 weeks, it's the Commonwealth Games. I won't be on campus, but I'll be available over Skype. I'm going to post my details later today. So I'll be available during my consultation hours, and if you see me online on Skype, I'm fair game. Just call me and I'll answer, hopefully. Again, I might just go offline if I get flooded, but again, during my consultation hours, I will definitely be available. Also, again, thank you for the rest of the semester. Good luck on the exams. If you have suggestions for how to make the subject better, use the TEval process. Again, the whole reason why the group project is done in class is because students in the past suggested it, and that's why it kind of got adopted. If you hate it, let me know. Maybe you got changes in the future. If you prefer or have some suggestions for an other area, please make those suggestions, because again, those will be adopted. Otherwise, again, good luck for the final exam. It is still like almost a month till it. You might forget. This is at least recorded, will be uploaded. And again, I will be available over the next 2 weeks, and even the week before your final exam. It's after the Commonwealth Games, so I will be on campus a few days, so you can see me in person as well. Cool? Awesome. I'll see you in a few weeks' time, and good luck in the meantime.